I'm very excited for today's show, ladies and gentlemen. Thanks for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we have joining us for the first time on the other side of the mic from Switzerland. So appreciate you taking the time out of the middle of your day. Zaheer Ebtikar of Split Capital joining us. We're going to be talking about, well, something that's been top of mind for me these past few weeks. We can give a little hap tit to Dan M at CMS. I'd have a harder time pronouncing his last name than yours, sir. Just sort of the landscape right now and the extent to which there's opportunity on the liquid side. You guys are one of the better known and well followed liquid investment firms in crypto. We can get into the origin of it in a second, but we can dive right into the meat. I don't know if listeners maybe caught the tweet that CMS shared over the weekend, but it sort of hits at this, it strikes a chord with what I've been hearing across the market, which is venture is crowded. There seems to be less deals out there, perhaps. And the third leg is a lot of the whinging I've been hearing from these venture firms, which is almost, it's very different from cycles past in which retail maybe would whinge about VCs getting in early on deals and then dumping on them. And now we have venture firms complaining about being locked up for several years and sort of sitting in Squidward fashion in their rooms whilst all the degens get to have fun punting tokens 10, 100%, which I assume our friends here, our guest, gets to do as a liquid investor. So let's just start. I kind of laid down the foundation very thick for the listener. Hopefully they drank their coffee and they're up to speed with what I just laid down. But let's give a little bit of maybe you can rehash the foundation I led. How do you view the sort of juxtaposition of crypto liquid and crypto venture from your seat at Split?
Yeah, so somewhere there's a bit of history behind this, right? I think the first question is, well, why is the venture market in crypto so important, right? If crypto is changing the money, which is the original intent of cryptocurrency, right? Like Bitcoin, Ether, these are all foundational monies, right? That people are aiming to kind of achieve. Then why are we focused so much on these private companies that eventually might tokenize and, might kind of become a real thing. But we're not really focused on the liquid markets that make this stuff up, right? We're not really focused on people actually using it. And I think to explain this a little bit better, historically, we got to kind of go back and understand, like, well, why is venture so important today more than it has been in the past? And why are people kind of getting a little upset? And it comes down to two major kind of reasons, or two major kind of inflections. And the first one is, geographically, like in the world, most venture is done in the US, right? Or in the Western world generally. And then obviously some of it happens in Asia as well, but the overwhelming majority happens in the US. And within some reason, back in, call it, 2015, 2016, 2017, and so on and so forth, there's a lot of like regulatory scrutiny even today, right? That, you can't just go and make a protocol tomorrow and launch a token because, you have securities laws, right? So this is what has kind of forced companies to stay private for longer as they figure out, well, what's their liquidity situation going to be? Is it an equity deal? In most cases, it's not. It's a token. And then in that case, then they have to think about, well, what's the legality behind it? And then on the other end, well, we tried one method of figuring out how to make VC better, which was ICOs back in 2017, which was just straight up securities offerings, more or less, right? So this kind of led to the 2018, 2019, 2020, saga of venture becoming more and more important as ICOs started getting cracked down by the SEC. Once this happened, then it was kind of, off to the races. Crypto started doing well. Bitcoin and Ether started doing well in 2020. And as this happened, more and more people wanted to become, investors in crypto. For larger institutions, they couldn't really do this on a liquid basis. They couldn't really go and buy, kind of the longer tail crypto names. And instead, they started investing in both venture fund managers and venture funds in general, and creating venture funds, right? So this was their exposure into crypto. But the problem is, there's a finite amount of how much money can kind of come into crypto venture. And that's kind of the theoretical limit that we're seeing in the last couple of, call it months to years now.
Yeah. So I guess what's funny maybe is you kind of, I forget, I don't know who painted this picture on Twitter, but to sort of provide some more color to what you just outlined, you have 2015 era, the Haslion age in which anyone could have participated in the Ethereum token event or the ICO, to now maybe there was a middle realm where you had both retail and venture being a bit more on or rather venture having not necessarily, retail not necessarily being on an equal playing field with venture. And it seems like that's kind of maybe flipped to an extent. Is that about right? Would you sort of describe it in that way? Or at least to put a finer point on it, maybe it's a bit more difficult for venture to see outsized returns, or to sort of see outside returns with the same ease that maybe they did a few cycles ago. Whereas degens, retail, or maybe have more opportunities than they did a few cycles ago. Is that a fair sort of summary?
I think it's both, right? I think it's also important to think about this in like global venture context, right? What is like the non-crypto venture end up looking like? And right now, that's also bad, right? So it's not just a crypto specific thing. Venture investing broadly is kind of dying off, right? You had it's very similar to all forms of finance, right? Like there is a bit of a gold rush event, right, that ends up happening, and then then the first wave comes in, the second wave comes in, the third wave comes in, and this happened with sales and trading for different desks back in the early 2000s, and then it went into private equity and banking, and then venture became kind of the hottest thing back in the mid 2010s when you had like gig economy stuff kind of really pop off. And now you're at the point where, there's been so much money globally allocated to venture that you're getting super diluted returns. I think Crunchbase posted some numbers like the other day. IRRs, internal rate of return, for venture funds, which is like the number one metric that they use, that and DPI, have come off materially since 2021. So I think you're already getting like this negative kind of drift. And I think the problem has been because other forms of finance historically have been pretty easy to move in and out of. Venture is a long game, right? You're saying we're going to invest in the best companies across 5 to 10 years, right? So the lagging factor is now like really showing itself in crypto, where it's like people are scratching their heads. It's like, do I really want to be invested at this like multi-billion-dollar L2 that like, who knows if it's going to pan out, and it's going to take like 5 years plus to get liquidity on. So I think this is now the question that people are asking themselves.
But liquid comes with its own sort of headaches, right? Whether it be, I think CMS painted the picture pretty correctly, but also very funnily, where you've got to stomach those 80% drawdowns, and you have to stomach your LPs seeing those 80% drawdowns in a liquid portfolio. Whereas if it's venture, you can sort of, mark to mark and kick the can down the proverbial road, as it were. So how do you sort of juxtapose the sort of difficulties one finds in investing and allocating capital in venture to maybe some of the drawbacks of liquid?
So it's good to peel back what venture looks like in crypto today, right? The vests are long, but they're not that long. Venture in crypto, more or less, is basically longer duration hedge fund trading. Realistically, right, if you have a 1 year cliff and 3 year vest, nobody in like the traditional world of venture would necessarily call that a like a long duration bet that you're making. That liquidity timeline is like very, very quick, right? You're basically a liquid investor, but you get to kind of lie to your LPs and say, well, hey, look, these aren't liquid positions on our book. We don't have to mark to market, the investment, right? And for those of you who are kind of following along, and what the mark to market really does is basically it shows your returns are materially better than what they actually are, right?
We call it massaging the books.
Massaging the books, right? Yeah. And in liquid, the problem is if you're running a liquid book, you're marked to market every single month, right? You're saying, I bought Bitcoin this month, the price of Bitcoin traded down, so now we're down X amount every month, right? And to Dan's point in the original tweet thread, and kind of the crux of why we started Split Capital, why we, kind of the focus of our fund, it's incredibly hard, right? Like you can't really run a liquid fund in this space without incurring drawdown, but also like you also can't be a fund if you're down 80, 90, percent every couple of years, right? Like there was a study done, I think a few months ago where there's like 3,200 hedge funds in crypto in 21. And now that number's down to like 700.
But now there's probably too few. There's probably too few hedge funds. Right?
Right. But crypto also has another problem, right? Which is adverse selection, right? Where if you're a good liquid fund manager, there's not necessarily a reason why you need to take outside capital to begin with, right?
Yeah.
You're not afforded any sort of extra better, anything for it, right? Like the best traders, CMS is a great example of this, right? Like,
yes,
he doesn't take outside capital, right? So he's just trading his own kind of capital and, with his partners and whatnot. But like, this is the archetype of crypto. You don't really get a better sort of angle on this.
That's one part, Zaheer, but there's also another element, which is something that I spoke with a friend who's raising a venture firm, early stage, $50 million, who's engaged with folks who want to launch liquid strategies in this market. Not only is there the element that you're talking about, which is you might as well you can do it with your own capital if you want to be successful without having to deal with all the headaches. But on the other side, on the demand side, there just isn't apparently LPs out there that want to deploy. And a lot of these funds are struggling to raise from LPs that I guess can stomach that risk. Is that an element you're seeing as well?
I would say that's true, but it's true for a different reason. People want liquid portfolio returns, right? Like nobody wants a black box return of a venture investor necessarily over like at current valuations. It becomes much more difficult. Like we're already seeing, and there's like headlines on this, notable funds in our space that haven't been able to raise as large as they wanted to on the venture side. It's not surprising why, right? Like when you're raising multi-billion dollars, like your return profile is going to get materially worse. Like crypto is a thin market, right? We're up a lot, year over year, but we're still not trading in the same kind of liquid way that we did in 2021. I think the more important part is that most of the capital allocators who invested in liquid funds back in, call it 2019, 2020, 2021, have gotten burned by bad managers or managers who basically lost a ton. And I don't blame them necessarily, not the managers nor the people that were allocating, right? And it's like when you're down massively on an investment, it's hard to kind of get back in the ring and be like, okay, well, let's go select another fund manager, which is understandable, right? So now, like most of the conversation we have with prospective investors and people that are interested, it's been how do you mitigate the downside risk, which is the best question to kind of ask, right? How do you think about not blowing out? And there's like multiple landmines that we saw, especially in 22, where it's like you could do everything right,
Yeah.
and then still end up in a bad spot, right? So that's kind of the risk.
The fragility of our capital markets.
Right. And it's like the credit risk, right? That you have to calculate as well, right? Like, if I'm trading like CME futures, I don't really have to necessarily think about like, well, is the exchange solvent on the other end, right? And I think we don't have to necessarily care about this too much anymore in crypto because we've thankfully gotten to a much better spot. But I think this was a historical problem. But to the earlier point too, I think we're now actually seeing a pretty big difference where there is a lot more appetite for liquid crypto because now investors have to make a choice. We want crypto exposure. What is it going to look like? And well, realistically, like IRRs aren't going to get better. So it's either liquid or venture, and there's no real third kind of party for this. Right?
And then what does that, let's maybe think about what that means for the market, the lack of, and I don't have any data on this to be clear. I have no idea, but I'm assuming just based on my network and just based on my gut, there's probably for every venture firm, maybe, I don't know, for every liquid hedge fund in crypto, there's probably like 3 early stage VCs, something like that. It just feels that way. Could be wrong. What does that mean for like the market in terms of price discovery, the efficiency of this market without sort of people really looking for those dislocations and those opportunities in the secondary? Is that why is that translating into more volatility or sort of price discrepancies? I'm sort of pontificating here, but I'm casting aspersions Is there any basis in that? Am I speaking out of my ass, or is that part of the reality?
So I think, yeah, this is a great question. I would say it's probably like for every, call it 50 venture funds in crypto, there's probably one liquid manager.
Wow, that's even crazy.
Right.
That's nuts.
Because again, I'm talking like people who manage at an institutional level, that kind of rigor. But the interesting thing is, I would say, like in because you can't really name many liquid crypto funds in the space, right? There's not
I can't.
Many.
And Zaheer, we're having a huge problem. Not a huge problem, but it's bothering me with setting up this conference in Prague at the end of the year, plugged for Emergence. I want to have a nice balance of buy side, and right now the buy side is just all venture, and I want to get some liquid funds and hedge funds and other types of allocators on the liquid side to balance out the conversation, but there just aren't a lot.
Yeah, and this is changing slowly, but it is a little early for it still. I think you're totally right. I think what ended up happening post 2021 and 2022 was, a lot of the larger kind of prop funds in crypto, almost every single one of them got nailed in some way, shape, or form, right? Whether it's Three Arrows, whether it's, Alameda, Wintermute, whatever it is, right? Like every single desk got hit in some way, shape, or form. And, this is also why our markets trade way more illiquid than they have in the past. There's not as many people that are, quoting necessarily, right? Like in the same way that the Chicago shops aren't quoting on Binance anymore, right? Like liquidity has dried up materially. It's made it harder to kind of put real size in the market. But I think you're hitting the nail on the head, right? Like I think at this point, people can kind of either live in delusion of how the market's going to move forward, right? Like you're getting multi-billion-dollar kind of protocol launches that are new, that have like no users, no TVL, nothing, right? And then their existing counterparts are trading at like 1/10, 1/100th the size, right? And they have real users, real traction, and people don't really care, right? Like, these things will even themselves out over time. But I think once this happens, LPs in these venture funds kind of really start to pull back and say, well, hey, wait a second, like, this was marked at 10 billion, it's trading at like, 150 million in a bear market, like, what happened, right? And once we see this like slow decline in IRRs, there will have to be a forced mandate change, basically, to where liquid investments are made much more, kind of a focal point for any sort of investor in crypto.
So how does that shift happen? How does sort of what does that shift look like? Is it a venture firm creating a liquid side pocket? Is it them maybe, I don't know, figuring out a way to launch some sort of vehicle through which they can invest in multiple types of liquid funds? But then there's the question of, again, the supply of firms doing this for that latter component. There's not that many options.
Right. And so this is where, we went from a fundamentally driven market, right, into understanding, like people have this like thesis on meme coins, right? As an example, right? It's like, if you have a thesis on a meme coin, then you kind of fundamentally accept that like the fundamentals theoretically today do not matter, right? That's like literally the acceptance, right?
So do you think that we've fundamentals maybe matter less now than they did 2 years ago, and that's the opportunity?
I think so. I think the market today has made the decision that fundamentals matter less today than they did 2 years ago, because 2 years ago you had some amount of buy-in on DeFi, some amount of buy-in on, X and Y asset. Now it's just like completely dead, right? This isn't to say the long run this will be the case, but I think for now, everyone's, retail's gotten like, it's like the evolution of the average investor in crypto. If you're still around, you're not dumb enough to kind of get hit, on these like different kind of positions anymore, right? Like you're going to adapt to whatever the market is feeding you as the sort of edge. And like it creates these like cockroaches essentially in every single investor that like you can't really get squashed anymore. The problem is, like you said, like there's not enough like liquid fund managers that I think are kind of taking up the mantle, and like the supply in the past hasn't been, necessarily the greatest either. So now it's like the free market, if you will determine, where the capital kind of gets reallocated to. But I think the most simplistic way that we'll kind of end up seeing this play out is two things. Either venture funds can change their LPA, change their subdocs within their, within what their investors kind of mandated, and say, hey, look, like, we raised too much money, or we can't really deploy this, and we need to do more, pure secondaries, or, equity secondaries. And then also on the other side of it, we're seeing more and more kind of now some venture funds moving towards the fund of fund model and saying we need to, basically bring on someone that can manage this capital in a real way. And there's not a whole lot of like really quality liquid, kind of folks that are in the market today doing this at size and scale and have a long track record, right? And I think this has been kind of the problem for a lot of asset allocators, right? Like, how do you grow, gain conviction behind any sort of manager that you want to put capital behind?
How do the ETFs change the dynamic for this? Obviously, a new sort of vehicle for exposure. Does that serve as a headwind or a tailwind for liquid managers?
It's a headwind for some and it's a tailwind for some. I would say it's mostly a headwind. It's a headwind, actually, I would say more so for VC than anything else, because now it's like, if someone, especially if you're in the US, right? And like, I'm talking about US markets more so than any other market. If you're holding an ETF and you hold it for long-term capital gains, right? Like, so you're holding it for 1 year plus, right? Let's just say, and if you're holding this, let's just say on a 5-year basis, it will be very, very difficult for, an underperforming fund manager to outperform this, right? So it's kind of like a BS test, basically, to say like, well, now I'm parking money in this thing, and this thing is like cheap, affordable, easy to execute. I don't have to think about it, and I don't have any of the headache of figuring out what to actually allocate to. And I think this will dry up demand in some way for underperforming funds. But I think, in another way, it's a tailwind, because now it's, offering people the ability to invest in crypto and then also kind of see, well, what if I wanted, definitive alpha in the space, or if I wanted, real kind of return on some of the longer tail stuff, then that's where better fund managers, I think, can start performing well.
Yeah, that's a pretty good point, because you got to think about, the return profile of something like ETH. Let's say it's trading at 3,000 over a few years and get to 10 or 12 or something like that. What is that? I'm going to have to do math, but you can see, you can see easily a 4x return on ETH over a year or 2 or 3. And that puts a little pressure on you if you're just some hodunk venture firm, because then you got to get in the 10 zone or the 8 zone or something in that respect. And that just makes it harder than beating the market, which is, I don't know, 10% a year, or something in that ballpark. So thinking about what these strategies look like, we in this conversation, and then in Dan's tweet there that we keep going back to, the word opportunity keeps cropping up. What are the opportunities in your seat that you see? Is it dislocations? Is it just literally seeing things that are cheap and buying them? What about the liquid market right now that's so wonky creates an opportunity for folks like you?
Yeah, there's a reference to the margin call, right? Where it's like, there's one of 3 ways to make money: be early, like be better, or cheat, right? And I don't cheat, right?
I don't cheat.
And I'd like to imagine we're pretty smart, but I think ultimately it's being early, right? I think there is a lot of value in being early, even on the liquid side, because I think people think, well, early means go down the risk curve and go buy the earliest stage, and you can justify returns. There's another point. I mean, we can even talk about this at maybe in a different segment, but right now, when we talk about like being early to an idea or trade, crypto is a land of opportunity. We never, as a firm, ever try to put our own thought onto what the market should do or should be. I think this is like the humbling factor of being in crypto for long enough, of being like, well, the market's wrong and I'm right, and that kind of thing. When in reality, you learn to be better than this and understand, well, we'll digest whatever comes in front of us, and then we'll take advantage of what we can in the right way, right? So something like Friendtech or Eigenlayer or whatever you want to call it, right? New novel mechanisms for each iteration of a new airdrop, right? Non-transferability. The token might now convert points into a different kind of format where it's not liquid all in one go. And like, there's like all these little, small schematics that we need to be like aware of and that we need to kind of participate in. And I think ultimately what kind of hampers a lot of folks who want to do this at scale, right, and do this institutionally, or even do this, on their own, is, do you really have the capacity to do this 24/7, 365? And I think that's where, sure, you can have the guy buying IBIT and that's that, right? But if you want something else outside of this, then you need a team, you need professionals, you need someone to do this at scale and like, have global market coverage in a way, right? So that's kind of where the value, I think, comes into play.
Is that where you prevent is that where you sort of can save yourself on that downside risk, almost more so than seizing on opportunities? If you're not up for, I mean, like, look at what's been happening geopolitically. These are, and please step in if I'm overstating or oversimplifying. I mean, imagine the opportunity in just recognizing that recognizing that pattern and having the dry powder to recognize an overreaction on the market whenever anything happens related to the Middle East and Israel, seeing that dip and then buying it. I mean, it's already happened 3 times. And to an extent, the pattern follows the same. I mean, I'm not a trader. I'm just my observation as a humble servant to the shareholders of the block, which is that the market, it speaks to how inefficient liquid is. The market completely overreacts anything, and especially when it's off market hours. And this first happened, I think, with the Iran strike news. Maybe it was a month ago, and the market just shit the bed. And even when you saw oil markets or oil futures open that weekend, it was down like, I don't know, 80 basis points, or, it was barely a reaction, whereas Bitcoin was down like 8% or something. I'm just making up numbers, but it felt like 8% if it wasn't. And that happened like 2 more times in the past like few weeks. And like, I don't know if you took advantage of that. I'm sure guys like CMS and guys like Avi did, where it's like, I don't know who's selling, but they're not smart money. They clearly have no idea that they clearly don't see. They weren't here for 2020 when we had the COVID drawdown, and so many of these drawdowns that either are tied to like they're really just leverage flush outs that happen. That are tied to something irrelevant almost, which is what that Iran drawdown was, and then they get bought up. And the market kind of gets to where it was before the news event. And anyway, long-winded way of saying, these seem easy, but there aren't enough people there to take advantage of them. Maybe
there's like
does no, you're
totally valid. It's all valid.
Okay.
It's all valid. There's like 3 things to unpack from this, and like the quickest answer to give you, right? It seems easy. Well, it does seem easy, but it's harder than it is, right? And I'll give this to the average investor, because it's like, if you have stuck around long enough, it's because you reacted quick enough to, major kind of seismic shifts in markets, right? So you have been trained to, sell basically as fast as possible when anything bad hits the tape, right? Which has caused, now like in these kinds of environments when you can't really adapt, you're just like, oh, bad thing happens, let me sell, and then I'll buy back later. And then that's like, obviously you're going to give up edge, right? To your point, and this is exactly it, right? So even in the liquid landscape that we see today, especially on the institutional side, again, I'm talking about outside managers here, it's been a focus of how do I make the best investment on a fundamental basis? How do I make the best investment on a liquid asset? The problem is you're not trading, I'm not trading S&P, right? I'm trading like multi-hundred vol assets. You mentioned Bitcoin, right? As an 8% dip. Like, I wish the average person, experienced an 8% dip. Still went down like 40%, right? Like, it's one of those things where I think people, especially when you're not doing this, like where you have to market and think about it and, kind of explain to your investors what you're doing. It's one of those things where you can forget how bad things really get. And I think in a market like this, we are in a growth asset class, right? So this is like our like we spent basically a year figuring out how we were going to set this up, what it's going to look like, all these things. This is a growth asset class. Most of the kind of capital made does not come from me trying to force my hand on an asset. It comes from someone else making a mistake and then me capitalizing off of it, right? Like it's like a Moneyball, right? Like they're giving you the walk, they're giving you the just take it, just pick up the free scoop and just take it and keep going with it, right?
Yes.
So I think we're in this kind of environment where everyone wants like massive winners, but like this is just not feasible anymore. We're multi-billion dollars pre-launch already for new assets. Like you're not going to hit 10x liquid anymore, 100x liquid anymore at size and scale. But you can make money, I think, consistently trying to be positioned better than other folks in these kinds of more irrational moves. And I think one last thing I want to comment on too on this irrationality is also like we saw a bunch of ETF outflows at the Pico bottom right in the last week, and it shows also that like the average person who wants to buy this stuff in size is also emotional, right? There's no certification that you're given some sort of better understanding of global markets, right? Just because you have more money or you do so with like a title or you work at JP Morgan or whatever it is. The only reality is like you can still kind of pick yourself apart in these kinds of moves because you're not, taking the right approach into the space.
So what is then the right approach?
This really applies to like, how you want to think about crypto as a whole. But I think, if this is a growth asset class that we want to basically get into the mainstream, then the mainstream effect will happen, right? If crypto is going to get institutional, in a major way, then that institutional focus will be there and the volatility will taper off in crypto over time, right? And what this kind of means is like you can't really treat these things as long run investments or whatever if you're doing this professionally, because they're not, right? These are multi-hundred vol kind of assets that you're holding and trading, and like this is why they puke out 50, 60, 70% in a book and you're making bad decisions. So I think you have to kind of treat the risk with respect that you have on the book, whatever it is. For retail investors, this is different, right? Like you want to punt and degen on count, that's fine. But I think when you're doing this at size and scale and scope and you want to have longevity here, then you have to kind of understand, well, hey, this is like a very difficult task. And over time, the space will get more and more and more kind of in the same, mindset as a traditional hedge fund or traditional venture or traditional PE or whatever you want to call it. It will look more and more like TradFi. And as a result, the people who will get it there, I think, will kind of embody the same kind of principles.
I know, but isn't that the double-edged sword, isn't it? Where, to your point, the juice isn't quite worth the squeeze anymore, which then maybe serves as an impediment for a potential liquid fund to enter the market because it doesn't sound too appealing as it once was, which then creates maybe this cycle of there being a degree of inefficiencies that you're talking about, which then means that we never close the gap, or we never sort of, how do we get to that point where these markets are efficient? If the opportunity is shrinking to an extent, I don't know. I guess the question is, does this become appealing, or how does this become appealing to new market participants?
I think we have to also temper our own expectations. Like you and I have seen, major wins right across the last few years, right? Like 10x. We're at the point now where like, oh, it's like a 5x, that sucks, right? Or a 3x or whatever, right? But like for anyone who's sane, right, this is like an amazingly good bet, right? I'll give you an example.
Fair enough. Everything's relative. That's an important point to make.
I'll give you an example. People are now talking about this whole FTX thing that, claimants are getting a bunch of value. I spent a bunch of time on this. I wrote about this back in the fall of 23. But the average distressed fund that actually, ended up making a ton of money on this, like they got, if they bought between 20 and 30 cents, they got a 3, 4, 5x on this.
Oh,
right?
yeah.
It's a huge win for them, right? This is actually how, what was their name? The Fortress guys got into crypto.
Oh,
right?
yeah.
Because they started buying claims
Mt. Gox.
of Mt. Gox And then they were like, this is sick. Like, we want to be a part of this industry. And then they kind of doubled down, right? So, ultimately, it's like, it might not be appealing to the guy who's like trying to make it with like $100 in an account, but there is a humongous world that is starved of yield, that is starved of any sort of upside, that will take 100% return as like, that is an amazing, year. So I think that's like kind of the direction that we're moving in. Again, there's still massive kind of outperformance that I think will happen across, multi years. Otherwise I wouldn't be doing this necessarily. But at the same time, it's that these things, people need to temper their expectations of how long it will take, how easily it'll be achievable. And like, like Crypto Cred had a great tweet about this, right? It's like your determinant of, basically saying like, what inning are we in, is basically how well you've performed so far. If you think it's late cycle, you want to clip carry and profits and you want to walk away. If you think it's mid cycle, it's like, you think there's more juice there because you haven't made enough. If you think it's early, well, like, you're just completely cooked, right? Like, right. And I think it is this kind of Rorschach test of depending on what you kind of want the market to look like. And I have, there are times when we speak to allocators, right? Even in a general environment, and they want me to tell them that I think it's going to do extremely well, but I can't tell them this, right? Because I'm like, that's not even what I believe in, right? Like, I can't tell them that like the bullish case for Solana is a 50x from here in, call it 3 years time or something, right? Like, it's just not a feasible kind of outcome.
I always thought about the innings with respect to how rich a certain return would make people I know in a given ecosystem. And if like, I'll make up a name. If Dan's going to be worth $1 billion at this price,
I'll make up a name.
I'm not gonna like, I don't think that makes a lot of sense. Like, so-and-so smart, but he's not billionaire smart. So that price target's too unrealistic. Maybe Joe being worth 100 million makes more sense.
Right.
That's when I take money off the table, is when, depending on how rich someone with a certain allocation to tokens will become. So that's it's a weird,
no, it's totally
weird
right.
way of thinking about it.
I think, it's market expectations are the best determinant of like, if you're actually going to walk away with any money at the end of the cycle, right? Like, I think this is the scariest part this time around, right? Everyone is like, when retail comes, but like, we all saw the Coinbase earnings report, right? Like, there is no material movement in how much retail is activity is here. In the same way, like, when institutions get here and asset allocation and all this stuff, and it's like, to what your friend said, there is not a lot of, there's not a lot of money coming into the liquid asset management space outside of the ETFs, So we know this empirically. We don't need to go around and guess, right? Like, I think ultimately what kind of counts in these types of environments is like, did I return actual capital? Did I actually make money? Or did I like, was I right about my investment thesis and wrong about the execution?
That's well said. Well, sir, thank you so much for taking the time. Really appreciate it. And hopefully this isn't the last time. I love that this season we've had so many new faces join, people that, I don't know if I should say this because it might get to your head, but Larry was very excited about this recording. But there's a lot of people that, we've known, we've followed, and they haven't been on the show for whatever reason. And so this year we've had a lot of great new faces on. And I've been enjoying it with great pleasure. Thank you.
I appreciate it, Frank. And for anyone who's actually watching this, make sure to come by in Austria in the fall. Make sure to come to the best conference of the year.
Czech Republic. But it's not too far from Austria. We would, when I lived there, we would drive down to Wachau on the weekends to the wine region.
Let me redo this.
No, it's funny. It's funny.
Let me re-record.
No, he did it on purpose.
I'm going to keep this as a running joke.
Yeah, no, it's great. I can't wait to tell our VP of research because he gets a kick out of it too. To all of our Czech listeners, we love you. You have a very special place in our heart. Good talking to you.
Thanks.